true, but then it became a housing bubble, right?
It turned into a housing bubble. So they morphed that into a housing bubble. So, well, let's just keep doing this and we'll move into the housing market. And now, is it possible that they can create another bubble? Is that something that is on the front here? Because we're looking at the future here now instead of complaining about the past. So
if there's one bubble that I'm worried about right now, you could say it's in the foreign exchange markets. It would be a dollar bubble. There's a lot of talk that we could have hyperinflation in the future. I don't know if we could have hyperinflation, but we can certainly have an inflation problem that's associated with a sharply falling dollar. The dollar has gotten stronger and stronger in this crisis, which doesn't make a lot of sense. The classic explanation is that it's a flight to quality. But you've got to ask yourselves, why would there be so much flight to the core center of the financial problem? The country that has the financial institutions that has created this crisis. One theory as to why the dollar is getting stronger right now, or has been throughout most of this crisis in the past couple of months, is that the hedge funds are very over-leveraged. We're in a process of deleveraging now. They've got their margin calls. They borrowed a ton of money in dollars. They must repay in dollars, hence a big demand that continues for dollars. So if that's what's happening, it doesn't seem to be a sustainable demand for the dollar. It's a transitional kind of demand, you can say, and one that's based upon collapsing institutions. That's a theory, and nobody really quite knows what's keeping the dollar high at a time when we've got a very large foreign debt problem.
Yeah, it's Tim, as you know, this is John again.
Yeah.
I manage a few $1 billion offshore,
right?
And we've looked at this long and hard. I'm looking at today's data. The dollar closed at 1.732 versus the euro. In the that's so strong. In the before before the credit crisis hit, before Bear Stearns fell, and I regard that as the tipping point, really. Dollar was trading at 157 versus the euro. So the dollar has enjoyed about a 30-cent rally versus the euro since this crisis. That seems so counterintuitive.
It does, and you would also think that the rising dollar would at least be helping our export partners. At a time when demand is falling globally, at least for China and Japan and other exporters, if their currency is getting weaker to the dollar, it might help them export. But it doesn't seem to have really that kind of effect. The downdraft is very severe worldwide at this point. And in fact, a lot of the credit crunch, or some part of the credit crunch, includes the market for credit finance, for trade financing. So that's having another adverse impact on the ability of developing countries to export to us.
And the other thing that seems counterintuitive is the collapse of gold. Gold was trading at about $1,000.
And throw oil right in there too.
For 2 years, for 2 years, I'd say I had it right spot on, and I was telling anyone who would listen to buy gold, and I wouldn't give that advice anymore. When gold starts declining and oil's declining the way it is, you got a deflation problem.
Exactly.
Yeah.
And explain to our listeners, let me get this out of my system, because
you got too much in there to get out, John. This will just be a little leak there.
It's John Sakowitz unhinged. You asked for it, you got it. Now, this is my theory about. I have two theories about the rally in the dollar. One is that the dollar really didn't rally. It's just that the euro fell faster.
Right.
So just on a comparative basis, it gives the deceptive appearance of a rally, but in truth, the recession hit sooner and harder in Europe.
Yeah.
Would you agree with that?
Yes, I would. I agree with that.
All right. Second theory is there's been a flight to safety in U.S. Treasuries, and as money has come into Treasuries, of course, the yield curve is as flat as it's been in history. 30-year Treasuries are going for barely 3%. 10-year Treasuries are going for about 2.5%. This is the flattest yield curve I think I've seen in my 29-year career.
And what's the short-term yield?
2-year Treasuries are about 0.8. And let's see, what did the short-term close today?
Under 0.5%.
Yeah. Like 0.3 The 6-month treasuries, I think, were at 0.35, something like that.
I just want to be in line when they pay you to get money. That's right. What I'm hoping for.
I don't want to get too technical here for our audience, but typically the longer you go out and in time, and I'm speaking to my audience now, the longer you go out in time, and lending money in 10 or 30-year treasuries, presumably the more yield you should be getting because you're lending for a longer period of time, and there's a lot of it. You should get paid for uncertainty.
Right.
So that's why the yields are higher. To have to be paying 3% over 30 years is insane. Think of the probability of a hyperinflationary period of time sometime between now and 30 years from now. Well, it's very high.
Well, but I gotta interrupt just for a moment. Everything you're saying is absolutely right, and yet we're in perhaps a liquidity trap that we haven't seen in this country since the Great Depression. So the Fed is pumping liquidity into the system, and you would think with the money supply growing, that would basically keep the price level up. It would raise interest rates to reflect an increased price level.
Right.
But in a liquidity trap, the British economist Keynes, he called it pushing on a string.
Right.
It's very hard to get an economy growing again when there's these deflationary expectations, when consumer sentiment and consumer confidence is down, when the marginal efficiency of capital, the expected rate of return on new investment is negative. You can't push interest rates down below zero. And when that happens, the only way to get the economy back on track is for the government to start spending money, not on these crazy bailouts for Wall Street, but spending money creating jobs like happened in the 1930s. I mean, it's been taboo to talk about this up until now, but it's time to start talking about it. It's past time to tell you the truth. And putting people to work who are losing their jobs to do productive things that hadn't been considered productive and didn't have much value for many years, whether it's subsidizing local school teacher salaries or paying people to clear underbrush so that forest fires don't get out of control, and creating civilian conservation corps and works projects and those kinds of things. If that's the only way to get the economy back on track, because otherwise you're pumping money into the system but the velocity of money keeps collapsing.
All right, now we're getting to the heart of our show. I was going to comment on that whole pushing on a string, and that whole deflationary scenario, and how that accounted for the lost decade of the 1930s here in the United States and for the lost decade of the 1990s in Japan, and what kind of effect that had on a rally in the dollar. But you're headed in the right direction on this show, and that is the remedy. We hear so much doom and gloom. You can't turn on CNN, CNBC, MSNBC, Fox without hearing a whole panel of talking heads just trashing.
I can't stand those talking heads, to tell you the truth. There's so much of that crap. Here, wait, let me give you my solution to fix all this stuff right now. What we're going to do is hire 12 billion people to build the roadway from Mexico to Canada, and we're going to pay them in Ameros. How's that sound? Then we can get Ameros in the market. We flood the market with Ameros, and the euro and the dollar go, what do we do? What do we do? Let's invest in Ameros. And we've got the new currency. We're done.
Enough of tomfoolery.
Okay, sorry. All right.
Enough of tomfoolery. I want to focus now. We have a rare opportunity with you, Tim. Let's focus on the solution. Let's focus on you're sitting in President Obama's office the day after he gets inaugurated, and he's asked you, Tim Canova, what are your remedies? What concrete recommendations do you have for turning this around? What would you tell him?
I think it's a number of measures. One, you need to put a floor under prices, and you have to start with housing prices right now, and that means a moratorium on foreclosures. Not a permanent moratorium, but something to give you breathing space to just stop the downward price decline. I'd say a state and federal revenue sharing program. The state of California didn't do anything wrong in this mess. Neither did any other of the states. This was the federal regulators either asleep at the wheel or very self-interestedly asleep at the wheel. There was, you could say, regulatory or deregulatory malpractice in Washington, and because of this downturn,